Thanks, Aditya, for inviting me for this session. It's always been a pleasure to participate at AIWMI X-Qualify events. And a warm welcome to all the audience who've taken time to view this session. A warm welcome to all of you. I would maybe straight away move into this. I would like to ask all of you who are looking at investments in the private markets one question. If you were to invest in one private market fund, which one would that be? So you've made up your mind, you want to invest in the private markets, you've done your analysis, you've got the allocation. If you're an institutional investor, you have an allocation for private markets, and you need to decide which one fund you're going to be investing in. How are you going to decide this? Are you going to do it like listed equities, or are you going to do it like the way the small retail investors do it? Listen to a stock tip received on a small cap company and invest in it? Or are you going to ask your friend, what are they doing? Which fund are they investing in? If you're an institutional investor, are you going to look at what other institutional investors are investing in and follow them? What is your thought on which one fund would you invest in? Or do you decide to do some research, understand the market yourself, understand the dynamics, and then invest? I mean, this is a long-term investing story. Private equity is not a short-term game. Once you invest in a fund, you are in there for next 10 years. It's illiquid. So you definitely need to take a well-informed decision. And let's say you decide to do it on your own, and you think what all are the options available. And you see in the market, there are various strategies in private equity, in private markets. There are venture capital funds, there are growth stage funds, you have buyout funds, private debt, and so on. And I mean, within each of these broad categories, there are sub-strategies as well. In venture, you will find there are a lot of seed stage funds, then you have Series A, pre-Series A funds, some late stage funds. What is going to be your criteria to decide which strategy you're going to invest in? Are you going to look at venture? Because there are so many unicorns happening in India. India is the fastest growing market in venture space. Investments are booming. Valuations are also going up the roof in venture. Is that a concern? Do you invest in venture, or do you look at buyout funds, which are more secure, more safer, lower volatility in returns, larger companies? Is that what you're going to be looking at? It's a lot of confusion. You need to spend time, understand the market, understand business cycles before you can decide which strategy you want to invest in. Let's assume you decided you want to invest in a venture capital fund. Then you move on to look at the market, and you suddenly realize that there are 700 active funds in India. And at any given point in time, there are more than 200 funds which are looking to raise capital, which are in the market, reaching out to investors. How do you decide which fund to invest now? You've decided on the strategy, which fund to invest now. You decide to maybe dig deeper into figuring out some data, finding out some performance details, but you come across a challenge. This is not easy as it is in the listed equity space. There is very limited data available in the public domain. It's not like you compare the performance of the managers with a benchmark, or you have all the track record details or past performances on mutualfundsahihai.com or any of the other websites where you can compare past returns. You don't have enough details on strategies of all funds. It's not that easy to get information. And that's the beauty of the private markets, that asymmetric information is what leads to a little bit of an alpha in terms of returns. And really identifying the best strategy and the best returns is what is all about. Maybe what is available is fund of funds. A fund of funds can provide a prudent way to invest in private equity. What is a fund of funds? A fund of funds is essentially a vehicle which is managed by specialist private equity professionals who would create a portfolio of private equity venture capital funds for you. So they would select the best managers, maybe 8 to 10, 10 to 15 managers for you, and invest in them over a period of time. And that's what the private equity fund of funds would do. What do you benefit out of this? You get essentially what you would get as an investor is access to specialist private equity expertise. you leave it to them. It's a hassle-free way of investing in private markets. You leave it to the fund of funds team, who would then identify what's the best strategy based on the business cycles, based on valuations at each stage, based on demand and supply of funds, demand and supply of capital. How are these funds going to exit? They will take care of all these aspects and identify the best funds, identify the best strategies for you. And they've been doing this for past couple of years. They have the network in the market, which is a key aspect in private markets. It's not like a mutual fund or a listed stock that anybody can go and buy it. I mean, these are closed-ended funds. They open for subscription or fundraising for a limited period of time, and then they are invested over the next couple of years. So if you are in the market, have the networks, then you know which funds are doing well and when are they open for subscription and so on. Not everybody has access to it. And more so for top quartile funds. I mean, top quartile funds close their fundraisings very soon and are also always oversubscribed, which leads to an issue that you don't get an allocation if you don't have an established relationship with them. And access is also a big roadblock for smaller investors or HNI investors, because these large funds always have a minimum ticket size, which could be as high as $5 million or $10 million. And in most funds, it's as high as 2 crores or so, 2 crores or 5 crores. In that case, then you don't have access to those funds if you're not a reasonably large family office or an institutional investor or an ultra HNI. So fund of funds solves that problem for you. I mean, they would pool in money from various investors and then invest into these funds where they come in as one single investor with a larger check size. And the other most important benefit what fund of fund brings in is creation of an optimal portfolio by diversifying the investments across vintages, across strategies, and across fund managers. Let's dig into this point in a little bit more deeper details. So how is that achieved? So this is a typical diagram of how a fund of funds structure would look like. So you have an investor, which could be an institutional investor, family office, or an HNI, who would invest in the fund of funds private equity vehicle. And now the fund of funds team would make investments downstream into 10 to 15 funds. So they would diversify your investment into 10 to 15 funds, which would be spread across vintages in separate years. It would be spread across strategies. So this would be venture capital, growth, buyouts, co-investments, early stage funds, so on. I mean, that is what the manager, fund of funds manager would decide, which is the best strategy to invest at that point in time. And it would create a portfolio of 10 to 15 funds. And now each of these underlying fund managers, as we call them, would have their own unique strategy. So they would be, say, for example, you've invested in a venture capital fund. So that fund would now make further investments into 10 to 20 venture capital companies, depending on what is their strategy. So essentially, each of these 10 to 15 funds would make downstream 10 to 20 more investments into private companies. And you have a portfolio of 150 to 200 or 250 companies, which are all very different from each other, because you've selected different strategies and each fund manager would then select 10 to 20 different companies. So you have a varied portfolio, a diversified portfolio, which captures the entire market of the private space and gives you the exposure in one single investment. And this is unlike the usual mutual funds, fund of funds in the listed space, because what happens there is the strategies are very similar. So if you pick up a large cap fund of, say, X mutual fund house and another large cap fund of Y mutual fund house, the probable constituents are all going to be same. You'll find Bajaj Finance, you'll find TCS and ICICI, Reliance, HDFC, and so on. So you don't, I mean, although you're diversifying across fund managers, but you don't find too many funds, too many underlying constituents being different. But here it's not the case. I mean, most companies would be different and there's going to be very little overlap. And let's see what this high level of diversification leads to in terms of mitigating risk and volatility. So here, this chart very clearly gives you, quantifies the number based on some of the studies done in the past. If you were to make a direct investment in a private company, that's the first column. The second one is if you were to make an investment in a single private equity fund. And third is if you invest in a fund of funds, what is the total loss risk? So what is the risk that your entire capital is wiped out. In a direct investment, it's as high as 30%. So 30% chance you get back zero for whatever amount you've invested. In a single fund, that risk drops to about 1%. There's only a 1% chance that you get back nothing in case of a total loss. But in fund of funds, that's practically zero. You'll never lose all your money. And also look at the second row, which is the average loss from a default. So if the company in which you've invested defaults or doesn't do well, in a direct investment, the loss could be as high as 85%. In a single fund, 29%, and in a fund of funds, it's very low, 4%. So even if some of these companies, underlying companies, the 150 to 200 companies don't do well, the loss at the overall fund of funds level is very low. And similarly, the volatility is very low. You don't see ups and downs in returns like you see in the listed equities or direct investments. And this is very safe, very secure as compared to the other options, that is direct investments in a single fund investment. And risk is significantly reduced. Let's look at the other aspect that the fund of funds does for you is manager selection. Before doing that, let's understand why manager selection is so important. When you look at a scenario in the listed equities space, manager selection, of course, is important, but it's not that crucial as it is in private equity. You saw the previous session, you've heard a couple of speakers yesterday. If you're looking at listed equities, most people, a lot of people nowadays are talking of passive strategies. The passive strategies, essentially the thesis is that over long periods of time, you cannot outperform the benchmark. And even if you manage to do, the outperformance is going to be in a very narrow band. And likewise, the underperformance is also going to be in a very narrow band. So in case you select a fund manager, a mutual fund manager, or a PMS in the listed space, and that turns out to be a wrong decision, the underperformance is not going to be very bad. And you also have an option to change the manager, exit the fund, and get into something else. But that's not the case in private equity. Here, as you see, the differential in performance between 5th percentile, so essentially those are the worst performing managers, and 95th percentile, which are the top performing managers, the difference can be as high as 50 to 55% annually. So imagine over a period of 10 years, this could make a real big difference to your portfolio, to your returns. So in case you end up being with a worse manager or a bad manager, then you're stuck for 10 years and the returns that you've lost are going to be phenomenal. So that's why manager selection is most important. And let's see why fund of funds can help you in this, because essentially they have much larger resources because of economies of scale and expertise. So they are pulling in money from a lot of investors and doing the work on behalf of a lot of investors where they can have higher resources. Let's imagine a situation that you are an HNI and you're looking to invest 1 crore in a fund, and you need to do due diligence, including legal and tax due diligence, and you hire the lawyers and tax experts. It would cost you anywhere between 20 to 30 lakhs. And on an investment of 1 crore, if you spend 30 lakhs on due diligence, that's just not going to work in terms of economics. Whereas when a fund of funds does it, they're going to spend enough amount of resources and their own bandwidth and time. I mean, due diligence for fund of funds typically go on between 3 to 6 months, sometimes as long as 8 to 9 months. And they've been tracking these managers over fund vintages over the last 3 to 5 years, checking their performance, tracking their performance. So they are definitely better equipped as compared to other individual investors or even institutional investors for that matter, who are not doing private market investments on a day-to-day basis. Of course, I mean, institutional investors have better resources in-house, but that still does not, I mean, the question is whether those in-house resources can perform better than somebody who's only focused on investing and selecting private equity managers. That's something to be seen. The other things which the fund of funds bring in is negotiate for rights for the investors. I mean, a lot of times we've seen cases in the industry where retail investors don't even get access to data room and all the data, forget doing the due diligence and forget negotiating for rights. That's what can be done when they come in through a pooled vehicle. The fund of funds will negotiate for best rights for its investors and in turn secure all the downside, secure the risks and move ahead. It also brings in administrative efficiency, reporting benefits and so on. Well, I mean, these are the broad advantages that fund of funds bring in if you were to look at. But any advantages and benefits, any solution that comes in, of course, comes in with a cost. So let's talk what are the costs, what are the risks, what are the downsides if you were to look at. Essentially, the cost is the management fee and the carry for the team who's doing the work for you, who's creating the portfolio, who's putting their hard work, putting in their experience at play. They would need a management fee and a carry. And of course, there are some fund expenses which are also charged to the investors, like the accounting, due diligence cost, fund management, fund administration, and so on. But I mean, in my opinion, these costs, of course, are there, but these are far outweighed by the benefits that the team brings into the table. It brings in its expertise to you. And if you are an institutional investor, the only other option is to build an in-house team. And if you're going to be investing in private markets, you're building your own in-house team, that will also have certain costs. You need to pay salaries to investment officer, benefits, legal expenses, accounting, due diligence costs are all going to be applicable to you as well. So that's also there which you need to consider. The other risk is, or the other downside is essentially when you're diversifying your assets, when you're diversifying your investments, it also brings down the return to an extent. But in our opinion, the benefits of diversification don't bring down the returns, but they bring down the risk to a significant extent. So it's in a sense, a risk-adjusted manner to access the private markets. And just one more point on the costs, which I believe is really important and which is not shown on this slide, and this is applicable more to institutional investors, is the cost of a decision. If you're using your in-house team who's doing investments in private equity on a part-time basis, the cost of lost profits or the opportunity cost or the cost of selecting a wrong manager far more outweighs any other costs or the management fees of the fund of funds or your in-house team costs. I mean, if you believe that your in-house team can do this as a part-time, your listed equities investment team can also back up and select private equity funds for you. And for whatever, I mean, if they get it right, great. I mean, that's fair enough. But if for whatever reason that decision goes wrong and you're stuck with the private equity manager for next 10 years who underperforms massively or is underperforming the best manager, the cost of foregone profits is going to be really huge. So from that point of view, fund of funds, I think, are most cost efficient compared to the other options that you have, that is to do it in-house or to do it yourself. So coming back to the question I started with, if you were to invest in one private market fund, which one would that be? In my opinion, that should be a fund of funds, because that's a hassle-free way for you to create a well-diversified private markets portfolio, which is being created by experienced team managers and who have strong network and manager selection experience. Fund of funds, in my opinion, definitely provides a risk-adjusted gateway to private markets. I'll end there and happy to take more questions.
Abhishek, unfortunately, we are out of time.
Out of time for questions. No problem. Okay.
Yeah. So our audience, I'm sorry, but I'll request you all to take up the questions directly with Abhishek on LinkedIn. He's quite accessible. And Abhishek, hopefully, I mean, we should have a standalone session, knowledge session soon. Maybe slightly more detailed one on this.
Yep. Yeah. We'll do. Okay. Thank you, Aditya.
Thank you so much.
Thanks, audience, for listening to this. Aditya,
thank you for joining in. Thank you for joining in.